Hello, everybody, and welcome back to Your Finance TV. Recording this on a Friday, so you know what that means. We've got Jay Pelosky here. How are you, Jay?
Hey, Scott, good to see you. Another slow week, right?
You know what? There's been a lot of earnings out, a lot of different names moving around and so forth. But you know what? I'm glad to have you here and to talk about those. But also, the title of your musings this week is Crunch Time. Now, we've all been through crunch time at different times in our lives. But run me through the thinking of the title for the musings then.
Well, I think I'm just channeling my own situation because I have to leave early today to take a road trip with my son for a fencing tournament. So I'm under crunch time, right? And then I was thinking about the playoffs. I watched some playoff hockey. I'm a Bruins fan growing up in Massachusetts, so not much better than playoff hockey. So it's crunch time in the NBA, crunch time in the NHL. And I think importantly for us, it's crunch time in the markets, right? I mean, we have the Fed. I think the Fed is going to go on hold after the meeting in a couple of weeks. We have the S&P coming to what I think is going to be the end of a long trading range, 240 plus days, oscillating around the 4,000 mark on the S&P. And it's crunch time between that iron sharpens iron contest we wrote about last week, right? Where you have the sell side equity analysts talking about accelerating earnings into year end versus fixed income investors who are pricing in a recession and rate cuts by the end of the year. Those two things, do not coexist. And so one of them is going to be right. And so it's crunch time for that contest as well. And, early read, as you pointed out, earnings, I think 25% or so of the S&P will have reported by the end of today, 60% by the end of next week. And, truth be told, there hasn't been anything really in the way of significant markdowns or downgrades to forward earnings looking expectations, which I would mark up as one for the positive column.
Okay, now I haven't had that much of a chance to go through all of the musings written out today, but I did pick up on one analogy in there, FUD. Now, I thought of Elmer FUD and all those sort of different other things. But fear, uncertainty, and doubt is what FUD stands for. Okay, so go a little bit deeper into this new analogy that you have of FUD.
Well, I mean, I think it's just emblematic of the environment that we're in, right? And I was on Bloomberg TV earlier this week, I think Wednesday morning, and talking with John Farrow on the Open about the recent IMF and World Bank spring meetings, where a friend of mine had noted he had never seen such bearish sentiment in his 20 to 30 years of having attended those meetings. And John was there and said, yeah, the sentiment is just horrible. And I think that's emblematic, whether you want to look at anecdotal evidence like that, or you want to look at the amount of cash that went into money market funds in the first quarter. The third most ever, behind only the great financial crisis and Q1 in 2020 when COVID hit. When you think about the back-to-back 7% returns in the S&P, and yet people were still bearish. There's just this unrelenting nature of bearishness that cuts across assets, cuts across regions, and I think is just not really being validated by the environment. And that's another example of where I think we're coming to. We're coming to a crunch point, right? We're coming to a decision point. Whether you're talking about policymakers, whether you're talking about economic data releases, whether you're talking about earnings, I think a lot of things are coming together, and we're about to have a move one way or the other, a significant move, I think.
Okay, well, listen, you have spoken about this for a while, right? Like you've been on the bull track and all sorts of side of it. Are any other people catching on to your way of thinking?
Well, it's interesting you asked that question because there are sprinklings through the various things we read here at TPW Advisory. And as you know, we have access to a lot of Wall Street research. We do read a lot. That's a big part of our process and our discipline. And I've noted a couple of things in the last week or so suggesting that some people are starting to get it. David Zara of Algebrist had a really good article in the FT this week talking about the buy case for European financials, something we've been on for quite a while, but very few people have been bullish European banks. He points out that the payout yields are approaching 20% with dividend yields of 7%. Some of the best earnings power seen in the last 20 years as Europe exits, obviously, negative interest rates where banks, of course, struggle to make money. Now rates are quite positive in Europe and banks are making a lot of money. And yet, as David points out, they're still trading at a 15-year wide discount to the rest of the European equity market. So that's one example. Another example is a guy I respect a lot, Martin Wolf, who's the chief economics editor for the Financial Times. And he wrote a piece recently on inflation. And, our view is that the Fed is going to validate a higher nominal growth world by not pushing rates up to get inflation down to 2%, right? That 2% target, completely arbitrary, nothing behind it, only been in place for a decade. So Martin was writing about his view as to how inflation and rates were going to play out, and basically concluded that inflation in the US is probably going to be 2 to 3%. We agree completely, more towards the 3. And then real rates of somewhere around 1%, 0 to 2, he puts it. So I take it as, say, 1%. And therefore, that's a rate short term of about 4% versus, and then maybe slightly higher as you go out longer duration. And guess what? That's where we are in the current rate structure. And that's our view, right? Our view is no recession in the US, our middle path. Again, as you pointed out, been talking about this for almost a year now. The middle path between high inflation and deep recession. And so we expect the Fed to go on hold, and we expect rates to basically stay around where they are because we don't see a recession, and therefore we don't see the rate cuts.
Okay, so factoring that in, it's the market sort of bounced around a little bit this week, or big moves around. Like, how are you seeing this all playing out at the end of the day?
I mean, that's obviously the $64,000 question, but I mean, our view has been and continues to be that the Fed is going to be the catalyst, as it often is, for the S&P to break out of this long trading range, right? That's how it usually works. S&P in a long trading range, Fed does something one way or the other, and that's the catalyst. We expect the same playbook this time. When the Fed goes on hold in a couple of weeks, whether it raises 25 bips more, I think is kind of less important than going on hold after that. We think that's going to be the catalyst to take the S&P up and out of the trading range, and so breaking above the 4,200 level, which is kind of the near-term resistance. And the folks at Carson Group pointed out that it's something like a new bull market, so 20% off the October low, which was, by the way, 6 months ago, is roughly 4,300. Okay, so if we get to 4,300, you're going to see the press filled with stories of a new bull market. And so we think that's going to lead bears to continue to capitulate going forward and drawing down some of that humongous cash pile, which, by the way, isn't doing anything but hurting performance. Cash continues to be one of the worst performing assets out there year to date. One of the worst performing in March when we had multiple bank failures. If it doesn't work when banks are failing, when is cash going to work, is the way I think about it. And so the Fed goes on hold, S&P breaks up and out, dollar weakness as the rest of the world accelerates growth. We just had a fantastic April composite PMI out of Europe this morning, right? Almost 55, well ahead of expectations. We've had significant good news out of China in terms of economic activity. So Asia is leading us into a new growth cycle. And the Fed on hold, plus realization that the rest of the world is actually leading us economically and in terms of equity market performance, that's going to lead to dollar weakness, further supporting rest of the world equity outperformance and supporting commodities. And so that's kind of our playbook. To simplify it, Fed on hold equals dollar weakness equals rest of the world equity and commodity outperformance. We continue to like credit, particularly in the US and in emerging markets. We think no recession. Credit is priced for a recession. There's no sign of it, but credit, and Goldman Sachs is out, another example, out this week talking about the opportunity in US high yield, which again, we concur with. We've held a position in US high yield for over the last year. So that's the playbook, non-US equity, particularly in this environment. We think Japan is really interesting. Maybe finish up here. Great example, right? No one has paid attention to Japan for decades and decades. But in the last week, you've seen two very big and well-respected investors focusing in on Japan. One is Warren Buffett, right? Value guy. The other is Elliott Associates, one of the more aggressive buyout firms and activist investors out there. Both of them talking about the opportunity set in Japan. And so we think there's a lot of exciting things, particularly globally, that we think will unfold as we remove the curtain of FUD, right? As crunch time happens, reputations are made, winners are determined, and we think we're coming, the next couple of months we think are coming, we're going to come to that crunch point, and the winners are going to be determined. And as we've said, we think the winners are going to be equity markets breaking up and out, not breaking down, and the bears having to capitulate, cash coming off the sidelines, and opportunities to be a positive investor and a positive outcome and returns over the course of the rest of the year.
Well, Jay, listen, it's a short and sweet show this week because you do have to hit the road.
It's crunch time. We got to get going. We got
a safe travels, but for anyone who's looking to read up on interview musings, they go to Pelosky.com, right?
Yeah, Jay Pelosky at Pelosky.com. Yeah, Pelosky.com.
Fantastic. All right, Jay, listen, safe travels, and we'll be talking to you again next week.
All right, Scott. Thanks as always, buddy. Great to see you.
And for everyone else out there, good luck investing.